Staff is here to address council again on this issue. We have some new information for you. We're basing our presentation on some questions that we'd received from council individually and as a group. But the basic premise is that we're asking council to approve a resolution to submit to the electors in the April ballot municipal election a question issuing sales and use tax revenue bonds, and it's predicated upon not raising taxes or imposing new fees, and it's for the purpose of capital improvement projects. This is what we're proposing. We're proposing that we address $145 million in backlog high priority projects, and paying for this by issuing the sales and use tax revenue bonds. So how will we pay for it? No new taxes. We'll make the debt service payments on the new bonds current with our revenue sources, and that's cash flow from our maturing skip bonds, along with some cash flow from our existing capital improvements program and budget already approved by council. And why this approach? Why do we keep talking about this? We know that issue 1B was defeated earlier in November, but and stormwater, we want to acknowledge, is important for our community and that we do need to take action. But stormwater is just part of our problem. And so our approach is a holistic approach. This is not new to you. We've been talking about it for some time, but we do have other needs. You know, as I had staff pull the statistics on the number of complaints that we receive and the sources of those complaints, and the overwhelming majority of those come from the condition of our streets, potholes and such. But also, you know, to continue to improve our neighborhood streets, and that would include concrete. But then we also have public safety facilities. I'll give you an example. As I met with council members, the police chief shared that example, but I want to do that since we're on TV. And I would just add that we have public safety in the audience. We also have constituents that this capital improvement bond item is important to. And I think you're starting to see some emails come through, as I am, that it's an important issue for our community. But for example, the Sand Creek Station, which houses the greatest number of police officers and has the largest call volume, is about half the size of the Falcon Station and also the Gold Hill Mesa Station. It's out of date, it's in poor repair, and it needs to be replaced. So that would be the kind of public safety example. And for Councilwoman Martin probably remembers that when we had our evidence issue some time ago, that was related to space. We're nearing capacity, and that this capital improvement program would address that. And then, of course, parks. I just anecdotally would comment that as we replace and are able to replace turf with these artificial fields, we're seeing, as a consequence to those decisions and those investments, the bookings increase by a significant amount for activity in the wintertime, which has had the added benefit of increasing our revenues. So, and I wanted to address, because I think there was some concern in terms of public process and have we done enough. So I wanted to talk a little bit about that. And so the list of projects included in this proposal have been pulled from our priority capital project list, and that includes stormwater and the folks that worked on the stormwater. Most of these projects come right off a list that was vetted by CH2M Hill and made recommendations. And there was, as we know, significant discussion over the last 2 years as it relates to that. And other capital needs projects lists have been vetted by our Capital Improvement Review Committee, and I believe a couple of council members even participated in that process. And then in 2013, that list was presented to council on 2 occasions. And then we have and I did this presentation, our unfunded capital needs presented. We presented that to council earlier in 2014. And then we've held community forums. We've held 7 of them thus far. We have one more scheduled for later this week, Thursday evening at the Stetson Hills substation at 5:30 in the evening and running until 7. And then we've included that input, and I know that Councilman Schneider, you had asked about that, and so on attachment D, we put those comments that we've received from the public. And as that support comes in for this initiative, we just would include that the Park Board has recently come out in support of that. And then we have our current project list, and this takes the input that we've received from the forums, and what we have done, and what you'll see a change in the project list, is we've included detention ponds as it relates to the stormwater, because that's important in the sense when we hear this discussion from the Lower Arkansas Valley folks in terms of our water quality and our water flow. These detention ponds are very important to that. And also in mid-year in 2014, Council approved the drainage criteria manual for all future development, which has a significant impact on the water quality and the flow. And we have our current project list, and that's an attachment in your packet. And we've tried to redline those projects so that you would know the changes from the previous list. And when we look at the proposed project spending, this hasn't changed. You've seen this before, but we've broken that out over a 5-year period in the different buckets: neighborhood, streets, stormwater, public safety, and also parks, for a total spend over 5 years of $145 million. So what I would like to do is to have Cara Skinner come up, and she will talk about the finance. And we also have Jill Jaworski here, who is our financial advisor, to answer some of the questions that Council had posed. So, Cara?
Good afternoon. So I want to just make it clear that what we're talking about this month is we're going to bring before you at the second meeting this month is the resolution referring the question to the municipal election in April. And that question is to authorize debt up to $160 million, specifically sales and use tax revenue bonds. And that is the issue at hand. If that issue is referred to the April ballot, and if voters approve, then there will have to be subsequent city council action with respect to the actual issuance of any bonds. We would then begin to work closely with the financial advisor, and we'd put together a financing team, and then ultimately bring back to you a bond ordinance for your consideration, which would have the details of the specific proposal at that time. So the issue at hand here is whether or not we put an issue on the April election for citizen authorization to issue debt. One of the questions that we heard both at the forums and from City Council is why now? And we wanted to make clear that why now mostly is because the issue is very important, our needs are great, but also the skip bonds are maturing in 2015 and 2016. And with that soon-to-be maturing skip bonds, we can issue new bonds in advance of their final maturity by just structuring the debt service payments of the new bonds so that we can fit the debt service payments of both the skip bonds and the new bonds within our budget. And so this chart just sort of shows how we can do that, how in 2015 and 2016 we still have a little bit of skip bonds that we need to pay, but combined, the skip bond payment and the new bond payment still can be made within our current revenue streams. And the other reason of why now is interest rates are at all-time lows. Now, I feel like we've been saying that for a long time, but we've been fortunate to have interest rates being low for an extended period of time. We don't know how long that's going to last, but they are very low right now, so it is a tremendous opportunity. So I am now actually going to bring up and invite to the podium our financial advisor. As many of you may know, and I believe you've met her because she has been integrally involved with our airport refunding bonds, our Briargate GID refunding, as well as our cab lease refinancing in the last year alone. Jill Jaworski, who's managing director with the PFM Group. She is an independent advisor to the city under contract, and there are very specific SEC regulations with respect to such, and that she has a fiduciary responsibility to the city. I just wanted to make that very clear, that she's has an independent view, but also does have this fiduciary responsibility. She serves as our advisor, and she advises us on all of our debt issuances with regard to structure, features, pricing. And she's available to not only mayor and city staff, but city council if you have questions with regard to any possible debt issuances. So I'm going to invite Jill up, and she's going to go through some of the financing issues that we presented in November, but then also really respond to some of the questions we've heard from you and from citizens. So with that, I'll have Jill come up.
Welcome, Jill.
Thank you very much. I'm glad to be here again today. What we put together here is a number of slides that just tries to address issues that have come up in conversation, and hopefully this will clarify and answer a number of the questions that you have. So first off, what is the financing plan? We're looking at issuing approximately, after voter approval, $160 million in sales tax revenue bonds. And that would be funding about $145 million in projects. It would also, the plan would be to be funding a debt service reserve fund, and there's about $1 million in there budgeted for cost of issuance. All of these numbers were based on some sales tax bonds that we modeled in September. So it was based on interest rates that were current at the time. The true interest cost was about 3.3% on those bonds. Luckily enough, rates have continued to go down, so if you were to be able to issue these bonds today, rates would actually be lower. It would lower your total cost on the transaction. Certainly we don't really know what's going to happen with rates going forward. They could go up, they could go down, and so these numbers are more than anything, they're indicative numbers. They're kind of creating a box that you would issue within. If assuming that you put the ballot issue in front of the voters, it's going to have the maximum amount of bonds that can be issued, the maximum repayment, that type of thing. If interest rates are higher, you'll issue less bonds. That we don't have any control over that, but we are recommending you stick with the $160 million that's been proposed. That's been discussed in a lot of public forums and in front of a number of different audiences. So we think that makes sense to continue with that number. And again, actual market conditions will dictate the amount of funds available for projects at the time of issuance. There's a few things that we need to think about in addition to just the basics of how much projects you're trying to fund, how long is the repayment period. The IRS has a number of regulations that you have to take into consideration and be cognizant of when you're structuring any kind of tax-exempt bonds. First off, they don't want the city or any other issuer to do what they consider to be over-issue bonds. So they don't want you to sell bonds and generate a lot of proceeds if you're not going to be spending those proceeds on projects in a relatively prompt manner. So the general spend-down rules are about a 3-year period. So as you saw from the table earlier, the current projection is that these proceeds would be spent over about 5 years. And what that really means is you won't be able to sell all the bonds at once. You'll have to do it in a couple of sales. Sell one probably this summer after, assuming you get voter approval. And then a second one in, 2 or 3 years, somewhere along those lines. This, of course, continues to expose the city to interest rate risk, particularly on the one that might be issued in 2 or 3 years or some subsequent period of time. It's a long time from now. We can't speculate as to what rates will be in 6 months. We really can't speculate as to where they'll be in 2 or 3 years. But there is a maximum repayment amount that would be put into the ballot language. And so if interest rates were a lot higher, that would limit the maximum sort of debt service exposure, and it would ensure that the costs would remain within, what the city is budgeting and projecting as reasonable and what they've talked already about. We're recommending that maximum repayment amount in the language be $242 million, and that essentially represents about a 50 basis point or 0.50% increase in rates from when the bonds were originally modeled in September. So allows for some modest increase, but nothing too excessive, and we think it keeps it into a reasonable repayment range. Another issue that we always have to be cognizant of with structuring tax-exempt bonds is the IRS regulations as far as the useful life of the projects. But these projects have an average life of about 38 years. The bonds are 20-year bonds, meaning the final maturity is 20 years, but since you're paying down principal each and every year, the actual average life of the bonds is under 13 years. So the useful life of the project far exceeds the term over which you're going to finance them, so that meets the IRS regulations handily and is not something that will be an issue on this transaction whatsoever. So getting back to, I think, what are some of the fundamental questions? You know, we sort of went over basic structure stuff. The first one off the top is why issue bonds at all? And I think that, this is the most frequently asked question for any city, or county, or state when they're planning on issuing bonds. Obviously, when you borrow money, you're taking on a multi-year financial obligation. So that's, an obligation you don't have if you don't borrow. That gives, that gives you a little more restrictions and less budgeting flexibility. So that's something to take into account. And then you're taking on interest costs. You borrow today, you're going to pay interest as you repay that loan. And those are, both things that you want to consider very seriously. So when you issue bonds, the main reason, there's two sort of main reasons why you do it. First off, capital projects tend to be large and expensive, and it can take a very long time to essentially save the money. Or in more municipal government budgeting terms, you have to set aside a capital reserve if you're not going to borrow for those projects. That can take an extensive period of time, and it's no different than when you go and you buy a home and you take on a mortgage. If you were to wait and save the money to buy the home, it would take a very long period of time to do that for most of us. There are lucky individuals, that's not the case. But for most of us, it would take a very long time to save the money to buy a house in cash, and we would not have the use and enjoyment of that house during that time period. So if the government is saving and reserving funds for large capital projects, those projects are not being built nor enjoyed by the citizens and taxpayers while that money is being reserved. A lot of times capital projects also have cost savings as far as operation and maintenance, and you're foregoing any of those cost savings while you wait for your capital project funds to be available. Typically, you cannot let a contract, a construction contract, unless you have the monies reserved in one way or another to pay for that. So you do usually have to save all the money for a major capital project before you can begin to embark it, or you have to do it in phases, and you can't do a construction contract for the whole thing, which adds cost if you're breaking it into smaller pieces. Importantly, these are all capital projects. They will have very long useful lives. So another concern folks often have is it like putting our budget on a credit card? It's not. These are not operating expenses. These are not maintenance expenses. These really are long-term assets. They're going to have benefits for a very long period of time for the residents. And then I think lastly, one of the most important components for why governments borrow is the concept of intergenerational equity. And that really means that it is considered best practice for a government to charge the users of its facilities. And so when you have a capital project that has a benefit over 20, 30, 40, 50 years, it's appropriate to spread the costs on that over all those generations of taxpayers. And when you're doing pay-as-you-go, you have to concentrate that into one generation, in essence, of taxpayers. And oftentimes you may have to raise fees or other things to generate enough money to do the project, which again sort of has one group of taxpayers and residents paying for a project that 20 years from now other residents are going to be enjoying. So that concept of intergenerational equity is very important in financing capital projects. Another major issue is the cost. I think, this is pretty simple math. We all know that if you pay for something today, it costs X amount of dollars. And if you borrow and you repay that loan over time, you're paying interest. And that interest is going to add up to spending more than if you spent it today. So we took a look at sort of what does that mean for this transaction. You're repaying these bonds over time. The interest cost that was modeled in these numbers is, as we talked about earlier, is about 3.3%. When we think about paying over time, the thing we really need to sort of work into our thoughts about that is we're not just adding 3.3% cost in interest, we're also paying that in future years. And in future years, the value of a dollar is actually less than it is today. So if we had a choice of like buying a house for, $200,000 and they said, you can pay $200,000 today, or you could pay that $200,000 in 20 years, we'd all say, well, I'll pay the $200,000 in 20 years because I know that the value of that $200,000 will be substantially less due to inflation. Everything will cost more, a dollar will buy less, and the dollar in essence is worth less because of that. So to properly think about these interest costs, we have to take inflation into account. So on that chart, what we tried to do here is say, okay, if we did these projects on a pay-as-you-go, there are $145 million in projects. We know that number. If we bond for them at the 3.3%, it's a little over $200 million in total debt service. But what if we think about what that debt service is in current dollars, assuming inflation? So we assumed a 2.5% rate of inflation, and that brings it down to a lot closer. It's more like $155 million, which is a lot closer to the $145 million in projects. That's at a 2.5% rate of inflation. That's lower than the current inflationary rate in this region, lower than it has been for the last several years. At an inflation rate of about a little over 3.5%, it's essentially a break even to today's dollars. And so, of course, if inflation were higher than that, you would be on a real dollar basis benefiting from having done the financing today, separate in a way from, the value of having those projects done. A second question that, I shouldn't say second, probably third or fourth, but another question that we've heard from a number of different folks is, why are you doing sales tax bonds instead of GO bonds? And there's several reasons why the city is focused on sales tax bonds. And, first off is really simple. You've done them before. The voters understand them. They understand the pledge. The voters seem to be comfortable with the limited tax pledge. So that's an important issue. The second, when you do a GO bond issue, one of the challenges is it's not a limited revenue pledge. And because of that, you have to be clear in your ballot language that if you needed to increase the mill levy to generate the monies to pay for the debt service, you would do that. And the ballot language has to say that explicitly. This is something that's been court tested. So if you see a decline in the assessed valuation, you would be required to raise the rates if you didn't have other funds available to pay the debt. And that has to be stated and told to the bondholders. And so having what is the sales tax, a limited revenue pledge without having to, if the money were insufficient, it would just be insufficient. You wouldn't be required to raise money elsewhere. That's a little simpler message, and one that the thinking is the voters may be just more comfortable with that than an unlimited pledge. The other piece is sort of a big picture, cost of funds piece, which is typically general obligation bonds have always been lower cost than revenue bonds, and so that always seems like that's the most efficient thing to do. I want to issue the lowest cost bonds. We've had a really interesting change in the market over the last couple of years. I mean, really interesting if you live in my shoes, maybe less interesting to you, but the market has shifted away from being in love with GO bonds and has become much more infatuated with revenue bonds. And this is because of a case that has nothing to do with you at all. And so when I bring this up, don't even think that I'm saying in any way you're in these shoes. But this is because of the Detroit bankruptcy case. So what happened in the Detroit bankruptcy case is the city of Detroit basically said that the revenue bondholders should be treated as secured creditors. They have a pledge of an asset, and just like in a corporate bankruptcy, they should be treated as secured. And they said the GO bondholders who have full faith and credit, meaning I'll do whatever it takes to pay you, they should be treated as unsecured. Because while they have full faith and credit, they don't have a secured lien on an asset. And so what has happened in the market is that bond investors listened to that and said, you know what, whether that becomes precedent in Detroit or not, and I don't even want to get into legally whether there is any, they came with a settlement, and I'm not a lawyer, so I don't want to get into that. But what I can tell you is that the investors thought that was a novel argument that carried a lot of weight. And investors have decided that that argument could come up somewhere else in the future, and we ought to pay attention. And then maybe what we thought of as the best kind of debt, GO bonds secured by full faith and credit, are not the best kind of debt. So at this point, the preference has shifted enough to revenue bonds that we often see revenue bonds pricing better than GO bonds. And if not pricing better, generally pricing around the same if they're comparable rating, whereas before they never would have. So that's been an interesting change in the market that I think supports that the sales tax bonds are something the voters are comfortable with. We also think that you're going to have a cost to doing sales tax instead of GO bonds. All right, so the next thing we wanted to address is how does this impact the city's debt burden? $160 million is not an insubstantial amount of money. Is this going to be burdensome to the city? Is it essentially too much debt? We took a look at what the city's limit is for general obligation debt, which is a charter limit. And at the current assessed valuation, that limit is just under $470 million. Now, these bonds are not subject to that limit. But we looked at it just for sort of context. If you add these bonds to sort of the other obligations, the cab lease, COPs, those kind of things, you're still well under the charter limit for GO bonds. So based on your own limits, it's very, very reasonable. We then secondly went and said, well, what does this look like in the context of other cities? How much debt you have versus other major cities. We looked at the top 50 cities in terms of population in the United States. There is only one city that has less debt per capita overall than Colorado Springs, and that is Louisville, Jefferson County in Kentucky. And also of note, that is a merged government, city and county, not just a city. And that can also make the debt limits look lower because counties generally have less debt often than cities do. You're spreading out your net debt per capita over a larger population base because you're looking at the whole county. But so comparatively, Colorado Springs has very, very low debt. So I think, it fits in with the budget when you look at the amount of money you're using on your CAP, that you're able to sort of fill in where you would have been paying the skip bonds in the past, and that's going away. And then from a comparative perspective of other entities, it's very affordable. Kara's going to talk about the ancillary benefits, and I think we'll be wrapping up the presentation relatively shortly.
Thank you.
Thank you. We did, when we had one-on-one discussions with city council members, we did note that we were going to run these capital projects through our economic impact model, and then we did do that, and we had it also vetted by a local consulting firm. And while this isn't a reason for issuing bonds, we do just want to acknowledge that there are some ancillary benefits of issuing bonds, and that there is a multiplier effect, and that there would be local spending value added. We approximated it at just under $300 million, and that there would likely be local jobs, not insignificant. There would be local jobs created every year of project spending, and that those jobs would range from 250 jobs to 460 jobs. And then last, but certainly not least, and I know certain other people could probably speak to this even more than I, but as we complete these really critical projects, they'll improve the condition of the city. And I hear that staff and leadership hears a lot from primary employers and prospective employers how important that is and how critical it is to the appearance of the city and the condition of our parks and our streets to potentially locating in the city or deciding to remain in the city. So it's very important to move these projects forward and improve the condition of the city. It's important not only to attract and retain those employers, but it's also important to attract and retain those young professionals and their families, as well as tourists. As we saw, we're starting to see an increase in tourism. We'd like to see that trend continue, and the condition of the city certainly is going to positively impact that if we can make these improvements. Also just wanted to reiterate that there's plenty of literature out there that it's good public policy, and there's many best practices about a combination of debt-funded CIP and pay-as-you-go CIP. Clearly, Jill went through a number of reasons why it's good policy to have debt-funded CIP. It's also good policy to have pay-as-you-go CIP, and we intend to continue to do that. Based upon our current budget, we believe we can maintain at least $8 million a year in pay-as-you-go CIP. If we continue to see strength in the economy, we would anticipate being able to add to that as we move forward. That amount was the pay-as-you-go CIP program, I believe about 3 years ago, was more around $5 million. So we've been able to increase the amount we've put toward pay-as-you-go even in these last few years, because it's now up to $11 million. So our plan, our recommendation is to have a very modest, when comparative, debt-financed CIP program to get some key projects accelerated, and to have a pay-as-you-go CIP program. And then we just wanted to make sure that you had in your presentation a map of the current projects. As Steve noted, there were a few modifications from the project map and the project list that was presented to you in November. So here's a map of the current projects. You can see that they are dispersed across the entire city. And then just again, wanted to reiterate that the question at hand is again, referring the issue to the municipal ballot, the municipal election in April. And next steps, we have one more Mayor Community Forum. It's going to be held on Thursday, January 15th at the Stetson Hill Police Station. I don't know if that's Stetson Hill or Stetson Hills. And then we will bring this back before you on Tuesday, January 27th at your regular council meeting with the resolution referring the item to the ballot. If you approve that resolution and it does get placed on the ballot, then the citizens will consider that at the municipal election. If we do get voter approval, the bond financing team will get together quickly and start working on the preliminary official statement, preparing the bond ordinances, doing credit presentations with the bond ratings agencies and such, and then we would be coming back before you to present and for your consideration the bond ordinance. So those would be the next steps that we would anticipate with this proposal.
Councilmember Gabler.